The one Trump trade that just won't quit, why Tesla's production problem is such a big deal, and BlackRock's Jeffrey Rosenberg. All today on The Bottom Line from the NASDAQ market site in Times Square. It's been 1 year since Trump was elected president, and the market is up 20% over the last 12 months. Trump continues to take credit for all the market highs, tweeting over the weekend, highest stock market ever, up $5.4 trillion. This is the fifth highest gain in 12 months following an election after Obama in 2012, Clinton in 96, Bush Sr. in 88, and JFK in 1960. Not everyone agrees that he's responsible for the entire equity rally over the last year, but according to a recent report at Goldman Sachs, he is at least responsible for companies that have small and mid-sized businesses as their customers, as people are expecting less and less regulation for small companies. Goldman Sachs maintains an index of stocks of about 45 stocks that have a median revenue from small to mid-sized companies of about 71% of their total revenue. This basket is up 38% since the election, almost double the S&P. Some examples of the names that are in this index are companies like CDW, which sells computers to businesses. They get over 50% of their revenue from small to mid-sized businesses, and they're up over 50% over the last year. Also, Square, which does the payments for vendors, they get 100% of their revenue from small to mid-sized businesses, and they're up over 200% in the last year. This outlook has also pushed the NFIB Small Business Optimism Index to the highest level in 12 years, a few months after Trump was elected. According to Goldman Sachs chief U.S. equity strategist, small business owners have been thrilled at the prospect of deregulation under the Trump administration. This might be the most resilient Trump trade that we've seen. While it may be hard to get exposure to small and mid-sized businesses, it's easy to get exposure to the publicly traded companies that have them as customers. And that, it seems, is what investors are doing. And that's today's bottom line. The Tesla Model 3 launched in July, but its rollout has been quite a mess. Elon Musk has called it production hell. But according to Business Insider's Matt DeBoard, it's even more dire than that. Last week, the company reported its worst ever quarterly loss and confirmed that the major bottlenecks with the vehicle was at a giant battery plant in Nevada called the Gigafactory. Apparently, Elon Musk has been spending a lot of time there, and Tesla's main product guy, their CTO, has said that it's basically his home now. The problem is so much worse than if this had just been an assembly problem at their plant in Fremont, because Tesla's only true point of expertise in the auto industry is battery production. Tesla's never been able to build cars as effectively as Toyota or GM, and skeptics anticipated that Tesla would have some production problems with the Model 3. However, few thought that Tesla would have battery problems. Now, new news this week, Tesla's director of battery engineering leaves to start his own company, according to his LinkedIn profile. John Wagner joined the company in 2013 and was involved in developing technology for all of Tesla's cars. And while Tesla has had a lot of exec turnover lately, the timing here is interesting given the cause of the battery problems and the production holdup. Wagner's departure may have nothing to do with the production issues. He was involved in developing the technology. The current issue is producing the batteries and automating it fast enough to keep up with the production that they've promised, which they clearly have not figured out yet. Earlier, I spoke to Fidelity's Matt Goulet on trends in ETFs.
Technology is a huge part of the market today. I look back, and technology was only 12 or 13% of the market back in 2002. Today, it's about 25%. That's a 10-year high. So technology has been really driving the whole market up. It's the leading sector year to date. Not a lot of losses there, but what we see going on is, in that space, we believe in active management. We have people who use our mutual funds, and they've had a great year of performance picking stocks. But we also see investors who want the ETF, again, for the tax efficiency. And when they use the ETFs for technology exposure, they can get broad sector exposure for 8 basis points. So Fidelity offers a technology ETF, ticker FTAC, that has an 8 basis point expense ratio and trades commission free. But we also see people using more industry level exposures. I mentioned this before, but cybersecurity, some of these more granular niche markets, you can get an ETF for quick access in the technology sector.
I'm here with Jeff Rosenberg, Chief Fixed Income Strategist at BlackRock here at the NASDAQ market site in Times Square. Thank you so much for joining me.
Thanks, Sarah. Good to be here.
So a lot going on this week. What do you see as the most important from a market's perspective?
Well, I still think that the most important issue with a little bit longer time horizon is going to be the evolution and what we eventually get out of tax reform and the tax reform debate in the U.S. There's a lot of global competition for what's the most important thing, but if you had to pin me down, I'm going to focus on that issue. And obviously, we were getting a lot of information with last week's release, the events that we expect this week. So this will continue to be a big focus for investors.
And where do you think tax reform will fall out, or what are the options?
So it's easier to answer the second question than the first because no one really knows. This is the beginning of the process. And so now we have the details. Now the lobbying efforts kick in. We don't really know what we're going to get this week. Later, we think we'll get something out of the Senate, may push into next week. And that's really important because what we have today, and now we have some real details, and we're sinking our teeth into those details. It's important not to overemphasize the current state. Already that's begun to change. You had Brady's amendments that have already gone through. So the process is an evolution. Where we end up eventually, no one really knows. I think there's a good chance that we get something. That's really not that important. What's important is what is that something look like at the end of the day? How close to what they're trying to accomplish with regards to supply-side oriented, fundamental tax reform does the eventual bill end up? Or does it devolve into something that's much simpler, easier politically to pass, but economically looks more like demand-side stimulus? Very different implications for financial markets, for the economy, for investors.
And what is the market impact if they get what they're trying to do versus if it's more demand side?
Let's put it at the very extreme. The reality will be somewhere muddled in the middle, but at the extreme, on one side you have supply side oriented tax reform. The idea economically is what you're doing is you're changing the supply side of the economy and growing the economy's productive capacity. If tax reform includes the essential elements of corporate tax reform, corporate tax cuts, investment spend, those are elements that really drive to the heart of trying to encourage incentives around the supply side of the economy. The economic impact of that is, remember, this is an economy that is late cycle. As Richard was on earlier, that cycle may have a lot longer to roll, but it's later cycle. So as we can see in the labor markets, there's a tightness to the economy. If you expand the supply side, you can potentially even extend the cycle, reduce inflationary pressures. That's because supply side is increasing. What's the other side? Well, the other side is you're just simply stimulating demand. And if you stimulate demand without an offset in terms of supply, then what's the impact? The impact is you get a boost to growth, but it's from the consumption side. It just presses on the pressures in the market around inflation. It tends to shorten the cycle, might prompt faster increases in interest rates, and potentially even an overheating that leads you faster into the next recession. So very different outcomes. One extends the cycle, that's the supply side. One potentially shortens it, that's
forces
the demand
up higher. And so talking about the Fed, what do you think about Jerome Powell, and how will that change the path that we've been on with Yellen?
So the other, kind of big focus is the changes around the Federal Reserve. And it's linked to the first conversation that we had around tax reform, because tax reform is fiscal policy. But fiscal policy operating for an economy that is late cycle, performing above capacity and at full employment is very important to how monetary policy responds. Fiscal policy stimulus of the demand side would be associated potentially with faster inflation and potentially, depending on who's running the Fed and how that makeup views the impact of that, faster pace of normalization. But that's where the personnel becomes really important. So we have Powell. Now, how does the rest of the board round out? What is the role of the staff? And the one thing that most of us are thinking about in terms of the impact of Jay Powell as a chair is, given his background, that raises the importance of the staff, the economists on staff. It raises the importance of the other members of the board around him. And there's going to be a great focus within the market around who are the next board members? What is their backgrounds? What is their tilts on the hawk-dove spectrum? So if you add some more hawkish members on the board, their voices are going to have a higher importance than, say, under a Fed chair that would have had more stronger monetary policy background.
And so when you look at the market rally that we've had, what is the catalyst that you think could most derail the market?
Now, you're talking about the bond rally or the
I'm talking about the equity rally.
We got a little bond rally
yeah, but
here.
you're a fixed income. But let's start with the equity rally. What's the one catalyst that's most likely to derail the equity rally?
I think we're not talking about like a little episodic derailment.
Like when it's finally over.
Yeah, you're talking about the cycle turn.
Yeah.
Right, and so cycle turns are associated either with a change in the business cycle environment, that is the market's reacting to that, and we just kind of talked about one of those scenarios, how do cycles end? Often people sort of blame central banks for ending them, but sometimes they're simply reacting to the inflationary pressures, maybe overreacting to the inflationary pressures. That's one way. The other way is that they overheat. So stimulative tax policy that drives inflation through driving demand beyond where supply is able to meet it is another way in which cycles end. The overheating can't be replicated, and so on a year-over-year basis, you sort of sow the seeds for recessionary outcomes. That's one way. The other way is through financial stability concerns and shocks and external events that really undermine confidence through the financial conditions channel. It's very much not the environment that we're in today, but it's certainly another way in which cycles end.
And what about the bond rally?
So the bond rally has been recent from the 247 intraday high. Part of that was, I think, going back to Taylor. I called it the Taylor tantrum, where nobody thought he was in the running, and then he was in the running. So we've taken that out. But the other issue is the global environment for bond yields. We focus on U.S. yields. It's not just about the U.S. So we had the ECB come out. They gave us what the market expected, but the commentary around it was perceived as much more dovish and extending the timeline of a very accommodative ECB policy, pinning interest rates down for an extended period of time, well past the end of net asset purchases, I think was the specific quote. But the market really keyed off of that, and you saw global interest rates rally. So you got a lot of cross currents between the shift from Taylor to Powell, movement on tax policy, but also what's going on globally with regards, for example, this most recent issue around the ECB, all contributing to a little bit of the bond market rally coming off of some of those near-term highs.
And what are you more concerned about or less concerned about? The interest rates rising and the disconnect between what the Fed says is going to happen and the market's perception, or unwinding the Fed's balance sheet?
I'm less concerned about the unwind of the Fed balance sheet. I mean, there's a scenario that you can play out further down the road about whether or not the balance sheet policy has to change. That's not really on people's radar screens right now. What people are focused on is the impact of the current trajectory of balance sheet unwind. And it's notable in the statement, balance sheet was reduced to one small sentence. And that is precisely the goal from the FOMC. Get the balance sheet off of people's radar screens. Balance sheet normalization is operating on autopilot. In the background, there's no signaling effect, there's nothing to get worried or surprised about here, and that, at least for the near term, is the issue. There's a longer term issue one can contemplate about whether or not there's not enough tightening rolling through the U.S. economy based on what the Fed wants to do, because it's being offset by financial conditions. Financial conditions are offsetting any tightening, right? So financial conditions today are easier than when the Fed started tightening. That might bring about a conversation about a change in the balance sheet, a more aggressive rundown of the balance sheet. And the other issue with the balance sheet that will be a little bit further out is, while Janet Yellen was very successful in starting the process of the balance sheet, she did leave for the next Fed chair, for Jay Powell, the determination of what the end point really looks like. What is the size of the balance sheet? What's the structure of the balance sheet? How is monetary policy conducted? Is it conducted with ample excess reserves, or do we go back to the pre-crisis environment of tight reserves and more traditional open market operations? That debate is kind of left for the future, and that will be very much part of the debate around the size of the balance sheet.
And help me explain this to my dad. Why do people who are just invested in stocks and bonds, what do they need to know about what's going on with the Fed?
Well, it very much comes around to the idea that the Fed is talking about its forward guidance. They're talking about the rate of increase in interest rates for 2018 and 2019. And there's a bit of a disconnect still between what the bond market is pricing and what the Fed is talking about. We've had that debate for a long time. The concern is whether or not the market would ever catch up to that, and if they did that in an aggressive manner, whether that might be potentially more disruptive. That hasn't been the case. We've been able to narrow the gap year on year, and those out years have been much less important. When we look into 2018, we're looking at 3 hikes into 2018, and the other thing that is quietly showing up for your dad and my dad as well, and my mom, is that income is slowly being restored. I mean, if you kind of look at the accumulation over 2 years, you're talking about almost 200 basis points. By the time we get back to the end, this time next year, that's a meaningful return of investment opportunity set to safe assets and safer strategies. And so that's going to encourage a rotation back into safe assets, safer assets, because safe assets will now have yield, where the push out the risk spectrum was very much fueled by zero interest rates. So how financial markets navigate that competition, if you will, by cash and cash-related instruments on the front end of the curve, starting to have some competitively priced yields, given where yield levels are in other areas of the fixed income market, that transition is going to have to be carefully managed and create some opportunities for investors like our parents, but it also creates some risks in how that transition is managed.
And last question, where do you see opportunities? Where's the best place for undiscovered opportunity?
So one place that I was just talking about is kind of the front end asset class spectrum. So you have some floating rate issues, not the high risk floating rate issues that have gotten a lot of attention in the zero interest rate environment, like bank loans and that sort, which add a lot of credit risk. But you have investment grade floating rate instruments. You have short dated instruments that effectively float because they have relatively short maturities, and so you can roll them over. You have some floating rate high quality instruments linked to floating rate indices. Those are increasing in terms of their attractiveness. On the flip side of that, in terms of where are some of the higher risk opportunities, a lot of the higher risk opportunities in fixed income have some pretty compressed levels of yield, and so we tend to prefer taking those risks in more the equity side of the portfolio. But one of the areas that continues to be attractive is some of the areas within emerging markets, and some of the emerging market debt still has some very strong fundamentals behind it. Right now, there's some challenges around some of the declines in emerging market FX currency, so we got to manage those short-term issues. But for some of the higher risk, higher yielding parts of the portfolio, those are some of the areas that we like.
Great, Jeff, thank you so much.
Thank you, Sarah.